If you blinked this week, you missed something important. Silver didn't just move a little. It didn't just climb. It exploded through a price level that people have talked about for decades but never really believed would happen. It broke above $100, and it didn't just touch it and fall back. It settled there, and that alone should make you pause. But here's the part most people are misunderstanding. Triple-digit silver is not the real headline. That's just the alarm going off. The real story is what changed underneath the surface while most people were busy watching stock tickers, arguing about politics, or assuming everything is normal. Before we go any deeper, let me say this clearly. I'm running a campaign to protect real analysis and real communities from copycat content. If these breakdowns help you think more clearly, support the campaign by subscribing and writing John AG in the comments. That helps the algorithm recognize where the real conversation is happening. Also, tell me what time you're watching and where you're watching from. I love seeing how fast this message spreads and how global this community really is. Today is Saturday, January 24th. Right now in New York, it's 4:48 p.m., and silver is sitting above a level most people thought they'd never see in their lifetime. Now let's get something straight. A lot of people look at a price like $100 and instantly say, it's too expensive now. That reaction is human. It's also exactly how people miss generational moves. Because price is what you pay, but positioning is what you build. The better question isn't, is silver expensive? The better question is, expensive compared to what? Compared to groceries? Compared to housing? Compared to stocks that have been pumped by years of easy money? Compared to the amount of currency being created every year? When you ask the question that way, the picture changes fast. Markets never give you a clean signal that says, now is the perfect time. They give you confusion. They give you mixed signals. They give you doubt. And inside that mess are clues. Our job today is to connect those clues. Silver suddenly started behaving differently. Not like a forgotten metal, not like a boring commodity, but like something people feel they need to own again. And when silver starts acting like that, it's not random. It's a response. One of the most important signals is what happens when silver starts outperforming the stock market. Think about that for a second. When stocks are the center of everyone's financial world, money flows there automatically. But when silver starts gaining ground against stocks, it means capital is changing its mind. It means money is questioning the story it has believed for years. There's a simple way to see this. Look at silver priced relative to the S&P 500. When that ratio rises, silver is winning the race. And recently, that ratio has broken out in a way that doesn't happen often. Now, does that mean stocks are crashing tomorrow? No. And this is where people get it wrong. Silver can surge even while stocks drift sideways or continue rising. The key point isn't an immediate crash. The key point is a shift in regime. These ratios don't change for fun. When they move after long periods of stagnation, it usually signals something bigger starting. History shows that these ratios can move to levels that sound crazy when you're living in the early stage. That doesn't mean it will happen tomorrow. It means the range of possible outcomes is wider than most people think. Silver is not moving alone. It sits at the intersection of money, fear, and real-world use. And right now, those forces are lining up. Silver is not just a monetary metal. It's a working metal. It's used in electronics, electrical systems, medical equipment, and energy infrastructure. And one of the biggest drivers of silver demand over the last decade has been solar energy. Solar panels require silver, a lot of it. And industrial demand has been hitting record levels. That matters because when industrial demand stays strong at the same time investment demand wakes up, the market tightens fast. It doesn't need a perfect storm. It just needs pressure from two sides. Annual silver demand has been hovering near 1 billion ounces, with total demand around 1.16 billion ounces. Industrial demand keeps setting new highs even as some discretionary buying cools. In a market that size, even a small increase in investment demand can turn comfort into scarcity. Supply is not as flexible as people assume. A large part of silver supply comes from recycling, and recycling doesn't instantly double just because the price is exciting. There are real bottlenecks. Collection takes time. Refining takes time. And when the market has been running deficits for years, those delays matter. Then there's inventory. People argue endlessly about whether there's plenty of silver out there. But the only inventory that matters is metal that's actually available for delivery. Recent reports have shown major exchange inventories dropping into uncomfortable territory after years of drawdowns. That contradiction, plenty on paper but tight in reality, is how stress builds quietly. Now let's talk about speculation, because this part matters. Silver can move violently. When the crowd discovers it, it can explode upward. And when leverage gets crowded, it can punish late arrivals just as violently. Both things are true at the same time. When silver goes vertical, smart people stop asking how high it can go and start asking how deep a pullback could be without breaking the bigger trend. That's where risk management lives. If you can't handle that question, your position is probably too big. Silver is also reacting to the same forces pushing gold. Gold has been quietly strengthening its role as a monetary hedge. Large institutions and central banks have been increasing exposure because they're thinking in terms of risk, not excitement. Gold often moves first. Silver follows, usually with more drama, sometimes smoothly, sometimes with a snap. Here's something that confuses people. Gold does not need the dollar to collapse to rise. The dollar can stay strong compared to other currencies while still losing purchasing power against real assets. That's why gold can rise even when the dollar index doesn't fall dramatically. The deeper driver is trust. Trust in policy, trust in debt, trust in future purchasing power. And right now, that trust is under pressure. The dollar index has been flirting with key levels. A weaker dollar acts like fuel for commodities. But even without a dramatic dollar fall, policy choices matter. Debt math matters. Governments with massive debt loads are extremely sensitive to interest rates. Even small increases in rates blow up interest expense. And recently, interest costs have been hitting uncomfortable records. This limits options. When servicing debt becomes painful, policymakers look for ways to manage it quietly. That usually means keeping nominal rates lower than inflation. In simple terms, savers lose slowly so the system can keep going. This is why discussions about future central bank leadership matter. Markets trade expectations, not just reality. There's growing talk about leaders who favor liquidity, lower rates, and tools like yield curve control. Yield curve control means the central bank steps in to cap bond yields by buying bonds with newly created money. It protects government financing and supports asset prices. But over time, it weakens currency confidence and pushes people toward hard assets. Wall Street often likes this because it's predictable. Liquidity solves problems in the short term. But it doesn't erase inflation psychology. It just delays the consequences. If we go down that path, the first reaction may be euphoria. The second reaction is often a rush toward real things. That's where silver and gold come back into focus. Now let me ask you something important. Do you think triple-digit silver is the beginning of a new era, or the final burst before a painful shakeout? Don't answer with one word. Explain why. Your reasoning matters more than your conclusion. Mainstream narratives always arrive late. When silver was ignored, it was called useless. When silver explodes, suddenly everyone has an opinion and a warning. Corrections happen, pullbacks are normal. But a pullback inside a new trend is not the same as a top. A pullback tests conviction. It shakes out weak hands. The biggest mistake people make is emotional trading. They buy because price goes up. They sell because it goes down. Then they buy again higher. That cycle funds someone else's profits. Instead, track signals. Watch silver relative to stocks. Watch gold relative to stocks. Watch real yields. Watch policy language. Watch behavior, not hype. Gold has been climbing quietly. Central bank buying has stayed strong. Institutions are treating gold as insurance again, not speculation. And silver, as the higher beta cousin, reacts more violently. Stocks can keep rising in nominal terms while losing purchasing power. That's why ratios matter. A market can be up and still losing ground to real assets. The Dow to gold ratio has been slipping, suggesting trust is shifting. Not panic. Repricing. Silver above $100 is not just about metal, it's about confidence. It's about people rediscovering an escape hatch. Policymakers are boxed in by debt and politics. The easiest path is more liquidity and softer money. Hard assets benefit from that environment because they don't rely on promises. Now bring this back to your life. If you own physical silver, your job is not to guess the top. Your job is to survive volatility. That means proper storage, discretion, and realistic position sizing. If you're new, avoid going all in. Scale in. Give yourself room to be wrong. If you've been stacking for years, protect your plan. Rebalance if necessary. Don't let greed undo discipline. Resilience matters more than predictions. Resilience survives inflation, slow growth, and panic. Not all hard assets move together. Sometimes laggards become leaders later. When metals move, broader commodities often follow. Markets can stay frustrating longer than you expect. Strategy beats bravado. If silver pulls back to test 100, will you buy or will you wait and risk missing the next leg? Think about why you'd choose either path. Doing nothing because conditions aren't perfect is a trap. Perfection kills progress. Silver can bubble. It can also consolidate for years. The way you survive both is position sizing and patience. Here's the base case. Volatility stays high, pullbacks happen. The bigger trend remains supported by demand, distrust, and policy pressure. Gains are turbulent, not smooth. Think of it like climbing a mountain in bad weather. You still go up, but it's uncomfortable. Your behavior matters more than your forecast. So treat this moment not as a command to buy or sell, but as a signal that something has changed. Watch ratios, watch policy, stay humble, stay disciplined. Silver doesn't need everyone to love it. It only needs a shift at the margin. That's how small markets move big. Is this silver reclaiming its role as a core hard asset or just a detour? Your answer shapes your actions. Your actions shape your outcome. I'll see you in the next video.